The housing market is not going to crash. Let me explain. The cost to purchase a home has skyrocketed over the last 4 years. Let's look at San Diego. In San Diego County, the median price for a home in 2019 was $595,000, and today the median price has increased to $902,000. That's 65% appreciation in just 4 years. And it's the main reason why a lot of people are waiting for the market to go down before buying a home. At this point, I think we all want to see prices come down, but it just is not looking like the direction that it's headed. And my job as a realtor is to keep up with trends so I understand what's going on in the market at all times. So I put my head down and studied all the data and historical comparisons to give you the best insight into the housing market's future projections. I'm Jamie Lennon, a local realtor who teaches you everything there is to know about living in San Diego. If you're looking to buy or sell anywhere in the greater San Diego region, as always, you can call, text, or email me anytime. All my contact information can be found in the description below. Okay, most of us remember the housing crisis in '08.
Nearly 250,000 homeowners are in danger of losing their homes.
But not only do we remember it, we witnessed our friends and our families losing their homes to foreclosure. This was the peak of subprime lending and adjustable rate mortgages. But to make a perfect storm, we need to have multiple elements. So to top it off, there were 3.8 million homes that were built between 2000 and 2008. That's 55% more than what's being built today. So what happened? The stock market crashed, there was massive layoffs, and when the term of those adjustable rate mortgages ended and rates shot up, now people really could no longer afford their homes. Then opens the floodgates of short sales, foreclosures, and REOs. So we have a pretty good understanding that history is not repeating itself, but it's still good to revisit so we can learn from our past. And during the Great Recession, home prices fell on average above 30%. All right, fast forward to 2023, and what we're dealing with is lack of affordability. A 65% increase in 4 years is crazy. And then on top of that, you add rates reaching 8%. And because of this, people have this assumption that there's no way house prices can keep going the direction that they're going. I mean, what goes up must come down, right? It would make sense. But if there's one thing that we can always count on, it's good old economics 101, supply and demand. So everything is going to fall under the umbrella of supply, because to truly understand and predict the future of the housing market, we have to understand what's going to affect the supply in the future. And what has the potential to do this? In order for a home to be foreclosed on, there has to be a minimum of 4 missed payments in most cases. And after the 120 days, the bank is going to issue what's called a notice of default. And after that happens, the ball gets rolling downhill really quickly. Now, headlines would have you thinking that the US is experiencing a surge in the number of foreclosures, but we have to look at the whole picture. When we look at the data, we see that it's gone up 8%. Okay, but we have to remember that there is a backlog of foreclosures from the pandemic, because over the last 3 years, there was forbearance and other relief programs out there that prevented foreclosures from happening in 3 years. It was from March of 2020 to March of 2023. And now they're just working through the backlog. But currently, there are less foreclosures on the market than pre-pandemic. In 2010, there were 2.9 million foreclosures, and in 2022, there were only 5 million homes sold. So just imagine what 2.9 million foreclosures would do in the current market. It would be absolutely devastating. Thankfully, out of the 5 million homes sold, only 325,000 of them were foreclosures. And this year, currently in 2023, there have been 185,000 foreclosures with a little over 4 million homes sold. Now let's say the job market crashes. That's going to have an impact on the housing market, and it's inevitably going to reduce the amount of demand and increase the amount of defaults. But hold on, 71% of all mortgage holders in the US have $200,000 worth of taxable equity. Americans are sitting on nearly $30 trillion in home equity. So even if the job market crashes, the amount of equity that homeowners have is going to prevent them from either needing to sell or their home going into foreclosure. In recent times, we've heard this term floating around called the lock-in effect. Essentially, when rates dropped in 2020, mortgage holders ran to refinance at the lower rate. And currently, 82% of all mortgage holders have a rate of 5% or less, and 23% have a rate of 3% or less. What this does is encourage homeowners to stay put. In the current market, more often than not, we're seeing people selling more so because they have to. So think relocation, divorce, there could be a death in the family. Of course, people want to move up, they want to downsize, but it's almost a double-edged sword at this point. People have all this equity in their home to put down on the next home, to buy the bigger home, to buy in a better location. And even though they have a substantial amount to put down on this next home, they're still going to be trading their cush 3% interest rate for the current market rate at 8%. It's putting people who want to sell in a tough spot. Now, if fewer homes are coming on the market, then what we need are new homes. But new home construction is not keeping up with population growth. In fact, it hasn't in the last 20 years. Last year, according to the Census Bureau, there were 912,000 single-family homes built, but the U.S. population grew by more than 3 million people in that same time. And since 2006, home construction has decreased by 55% nationwide. And to top it off, builders are dealing with a much longer permit process than pre-pandemic. You add that and the cost for building that is shot through the roof, and dealing with certain zoning restrictions, all of this has kind of deterred builders from moving forward. And in San Diego County, you have hundreds of thousands of acres that are preserved land. Just driving through the neighborhood, you see canyon after canyon, which is great, don't get me wrong. It's what prevents it from turning into the next LA. But a lot of that space is under conservation, so there's not going to be too much additional free land that we can use to build more housing. There's going to be conflicting data on this, but a lot of the headlines are suggesting that we need about 4 to 6.5 million homes just to balance the market out. Now, the biggest question I hear is who can afford to buy these homes? Who can afford to pay $1 million plus for a home here in San Diego at an 8% rate? All right, check this home out. This just sold October of this year for $999,000. And to assume like putting 20% down, you're looking at a payment of $6,600 a month. Now, just for fun, let's take a look and see what the same home, how much that would cost us in 2021 with rates being 3%. That is what some people are spending on a 2-bedroom apartment here in San Diego. So who's able to afford a $7,000 mortgage payment here in San Diego? There really is no set income amount, and that's because there are other factors that we have to consider. One of them is how much debt you have, what your debt to income ratio is. And another one is how much cash you're bringing to the table. So somebody could be putting 50% down on a home. So if we're using $1 million home as an example, their loan amount would only be $500,000. But it is safe to assume that buying a home in the 7 figures, you're looking at a multiple 6-figure salary. And the median salary here in San Diego is $89,000. It would seem that something's not adding up. I mean, I look at houses all day and I'm still blown away by the prices here in San Diego County. I mean, a normal person working a normal job is not going to be able to afford the median price of a home here. Take a teacher, for example. A teacher could not afford to buy a home with their salary alone. Insert gift funds from family. You might be thinking there is no way, but I can't tell you how many people I have represented that have received gift funds from family members to either buy a house for all cash or been given the amount for the down payment to buy a home. But it's actually more common than you think. It's the era of the Nepo home buyers. In fact, studies have been done that show about 40% of under 30s received help from family for the down payment on a house. If we look at this article, New York Times found that boomers owned 44% of all real estate in the US, with most of these homes being paid off. So that's a lot of liquid cash. And if 1 + 1 = 2, then yeah, a lot of these boomers have the funds to secure their kids' or grandchild's future. Another reason that people are able to afford these homes is from the equity that they built selling their previous home. Remember, the average homeowner in the US has $200,000 in tappable equity. So having a substantial amount to put down on the next house is going to qualify you for that $1.5 million house in a better location, in a better school district, bigger home, maybe an extra bedroom for the growing family. In 2022, 1/3 of US homes were bought in cash. So interest rates don't impact those with cash. And that trend has continued into 2023. When rates were 3%, it didn't necessarily make as much sense to buy a house with all cash because it was so cheap to borrow money. So people would get a loan and then invest the rest of their cash somewhere else. Nowadays, not so much. The buyers that are paying cash for these properties, well, you have a good portion of them being the boomers, and then also a large population that hit big in the stock market in the last few years. And lastly, we cannot forget about the demand to buy investment properties. You know, back in the day, owning a home was about having a place to live, owning a piece of land and having that security for your family. But nowadays, it's our retirement plan. And the trends for wanting to be a landlord, it's only increasing. You see it all over social media. All you have to do is scroll how to be a landlord, and it's just one after the other, all these videos teaching you how to be a landlord, how to invest in real estate. News travels fast these days. Information travels fast these days. So anything that you want to know, you can look it up by the click of a button, and you have all the information you need. And this is not going to only increase the demand, but it really limits the supply, because nowadays people own multiple properties and they hang on to those properties for a very long time. In fact, there are over 143 million homes in the US, and 65% of them are owner occupied. That means that 35% of all housing units in the US are rented. The age of being a landlord, I feel, is just the beginning. More and more people are trying to find ways to invest in real estate to be able to retire early. I mean, who doesn't want that? And owning real estate provides that. It would seem nothing, not even having the higher mortgage rates in nearly 23 years, can stop the continued climb of home prices and the desire to own property. Understand that real estate is local and it's going to be different for every market. But here in San Diego County, homes have depreciated 10% since the peak in 2021, but over the last 4 months has gone up 5%, making the net difference about 5%. But okay, it goes up, it goes down, it's always fluctuating. So let's just meet in the middle and say homes have depreciated about 7-8% since the peak in 2021. And for the market to crash, there would have to be too many homes for sale. Comparing the market in 2008, there was an oversupply of properties. Nowadays, we have a massive undersupply. And what I'm seeing right now is a stabilized, neutralized market, which is healthy. It's back to just a steady increase. That is what we like to see. But the second interest rates go down, demand is going up. People want to own homes. Millennials want to own homes. And there are 72 million of us in the US. You know, no one has a crystal ball. We're just going through life, doing the best we can, hoping that we're making some smart decisions along the way. And I want you to understand that this is my professional opinion. And at the end of the day, you and only you are going to know what's going to be best for you and your family. I think we can all agree that we don't necessarily like what's going on right now, but we have to be realistic. I know a lot of us are inevitably just waiting for the market to crash, but honestly, I just don't see that happening. Instead, I see the dream of homeownership dwindling for the next generations. So what do we think? I would love to hear your questions and comments, so please leave them down below. And if you are looking to buy or sell anywhere in the San Diego region, know that you can call, text, or email me anytime. I will be here for you to help you make that move out to the best in the West. And I'm gonna leave you the same way I always do, and that is to stay classy, San Diego.